Hey, good morning, everyone. Marty Mizora here, December 17th, Tuesday, 2019. This is part two of this week's presentation. Yesterday, I walked you through highlights of general conditions, our current assessment, and our concerns about the corporate debt market, as well as valuations and other things and similarities, particularly to 1999 in today's marketplace. So, very different setup than we've had throughout the past 10 years of this bull market. So, such conditions demand a change of strategy, a new allocation among asset classes, and some hedging for sure. So that's what this morning's presentation is all about. So on your screen, you notice the title to begin with, Current Allocation Correlation Matrix. So I'm just going to jump right in. Okay, so this is a correlation matrix, and these are our core ETFs, or exchange traded funds. This basically captures our current equity exposure. A correlation coefficient of 1 means that the two securities that line up with each other move exactly the same. So obviously DEM, which is an emerging markets exchange traded fund, is going to move with, of course, DEM. But EFA is different, and that's going to move a little differently. So the closer you get to 1, the redder you get. As you deviate from 1, as you have less correlation, you get blue, and ultimately you get green. So as you can see, folks, this is not an optimal looking correlation matrix if you're looking for true diversification. Now, diversification often is in the eye of the beholder. Without understanding or using these tools, folks would say, wow, it's very diversified. You have emerging markets, developed markets, you have US communications, you have materials and energy and so forth. Wow, that's very diversified. Well, it's not. If we have another big bear market like 2008, just like then, all of these securities are going to move down pretty much in tandem, albeit to different extents, but move down they will. New core allocation, and I'm just going to walk you through this. I do have narratives for each individual position, but I'll just highlight them for you here. So in order to truly create a less correlated mix of asset classes, we need to step into areas we haven't been in a very long time. To begin with, we want to own some currencies, and we're going to do it through exchange traded funds. Initially, we want to own the British pound. Why? Because of the positive Brexit outcome that we anticipate this year, and therefore capital flow to Great Britain. The euro, also a positive Brexit outcome. Eurozone economic potential, and I would say relative valuations of Eurozone equities relative to the US. These things could ultimately result in a strong euro as capital flows to the Eurozone and then away from the dollar. The yen is arguably the safe haven these days, believe it or not. Has a lot to do with what are called carry trades. Folks borrow in yen, sophisticated investors do, at a very low yield, and then invest that in other places. When things get shaky in other places, you see an immediate increase in the yen as money repatriates and comes back, because you don't want that other currency to devalue against the yen. That could put you in big trouble in terms of repaying those yen loans or having the currency to do that. So in the evenings when I watch currency markets, I always go there first before I look at pre-market trades or futures trades for stocks, etc. Often I can tell you how the market's going to open based on how the yen is trading. If it's rising, that tells me that there is risk rising in the more speculative currencies and markets. And more often than not, when the yen is rising against the dollar, the market is down. So that plays into global weakness, unwinding of carry trades, further trade tensions, and make no mistake, folks, we will see further trade tensions in multiple regions throughout the world going forward. Therefore, we want to be short the dollar. The Fed is printing money like there's no tomorrow. Believe it or not, they're supposed to print another 500 billion between now and the end of the year to take care of that repo issue, or at least to keep it under wraps. I talked a little bit about that on yesterday's video, but again, it's just pumping more and more liquidity into the system. We have a scheduled $1.3 trillion budget deficit that's going to require the Fed to basically monetize that, not officially, but that's essentially what's happening. And then probably more economic uncertainty as we get into next year. So the dollar, I think, will be all over the place. My base case right now is that it'll trend lower. Gold, yes, we do treat gold as a currency, make a real strong case for gold, but right now let's just call it a defensive currency. Alternatives, 10%. SJB is an ETF that shorts junk bonds. I'm using that as my example here. We'll use it. We may use it with a combination of options or options only. It depends. These are interesting. These inverse ETFs, you have to know how to manage these. They're really meant to be owned on a short-term basis. Folks, make no mistake. If you watched yesterday's video, you should agree, plus a lot of the other things I've been sharing with you on the blog. Over the next year or two, however long it takes, people who are short junk bonds are probably going to have a very nice payday as a result. So we want to be there in your portfolio as a great diversifier as well. Developed foreign equities. In the Eurozone, there's an interesting story there. We're going to talk about the hedging here in a second. I do think we are going to see some major stimulus out of Japan and China. And of course, that could very well equate, at least for a while and at times, to higher stock prices, barring, a global recession, which we think is more likely than it's been the last 10 years. Doesn't mean there's a strong probability, it just means more likely than it's been. But if there isn't, stimulus out of Japan and China will help and will probably be okay for equity prices. Germany, interesting setup there. Depending on what data you look at, it's either bad or not so bad. Lately, it's been more bad than good. One thing that makes Germany unique is that they have a low debt to GDP ratio relative to the rest of the world. They're actually running a very nice budget surplus. They've been very disciplined, somewhat austere. They are the whipping child for the rest of the world. People are not happy with the German government for not embarking on a fiscal stimulus package. They have said that if we end up in recession, we absolutely will. So Germany has unusual room to stimulate its economy with government spending. And I see that happening if I'm right about the weakness in the global economy. So that would be a boost to what are relatively cheap, stocks in the Eurozone. France, believe it or not, from a macro standpoint, France looks the best pretty much across all developed markets. The French PMI that came out night before last, still in expansion mode. It was a little weak, so that's going to come down just a little bit. But again, this way we still get our foreign exposure, and we take advantage of flow, coming out of the dollar into European equities. Have a little bit of exposure here to Asia as well. Emerging foreign equities, we want to own some Brazil. It's got a very good macro score relative to other emerging markets. I say very good. It's just nobody's really good. Theirs is just better. U.S.-China issues, which folks are not going away because of the phase one deal. That plays well into places like Brazil. What I really like about them is they have a policy rate of 5% versus our 1.5%, and they have 2.5% inflation. So they have room to actually use monetary stimulus like few countries do. Russia, similar situation, pretty good macro score. We see oil supply issues. We see strong incentive to keep the oil price higher. That plays into the Russian story. This stage of the cycle, maybe the third phase before you get into a real weak economy, oil and inflation tends to rise. That would play into Russia's story as well. Big divergence, kind of like very similar, that is, to Brazil. 6.5% policy rate, 3.8% inflation, and Russia is crazy cheap, trading at only 6 times earnings. And then the Vanguard Emerging Market Index Fund, which gives us broad EM exposure, and it does, like VPL, which is developed fund, gives us exposure to stimulus that may happen in China and Japan. U.S. equities, 45%. Financials, we're going to cut those back. We're going to be 10%. We're using 2 funds now. We were 15%. XLF gives us broad exposure. KBE is just purely banks, no insurance company exposure. That's important because insurance companies, along with pension funds, are hugely exposed to that triple B debt story that I told you yesterday. And we do expect some consolidation among regional banks this year. We think the setup is for that, and that will play well into KBE. Materials, 8%. I said just trade deal here. I would add global fiscal stimulus, spending, infrastructure, that sort of thing. The potential is there going forward. Same thing for industrials. Energy, geopolitical risk plays into energy, U.S. supply destruction. We'll get into detail on that probably in a later blog, but we are seeing some of that. OPEC cuts, prospects for this phase of the cycle, at least for the next several months anyway. Tech, 5%, big decline in tech in terms of our allocation. Again, we've been whittling away at that. Very expensive, way too much exposure to the S&P. S&P comes down, if people leave the market, tech gets demolished and so forth. But there's idiosyncrasies there within the top holdings that we want to be in, probably. Communication stocks, same thing. Plus, we want to have 5G exposure. We want to own specifically Verizon and AT&T along with the communications. They pay really nice dividends. Of course, the biggest players in US 5G from the top down. Consumer staples, that's defensive in a weakening economy. Healthcare, we've got demographics, aging population. Makes sense to own more healthcare. Makes sense to own utilities when you want to be defensive. Makes sense to own REITs when you want to be defensive. So again, there's bigger narratives on each one of those, but that pretty much gives you the basic justification. Okay, so gold, just one thing on gold, because people struggle with that. Have clients who just absolutely have to have it, and have clients who say they don't want it. Well, I really think we want it, folks. Gold is a very viable asset class, and I'm going to call it a currency to own. And it's times like these when you want to own it. This is the yield spread or the curve, 5-year treasuries versus the Fed funds rate, and the 3-year treasury versus the Fed funds rate. They are inverted currently. They were inverted during 2007, 2008, and they were inverted during the previous bubble bursting. And they're inverted now. This is gold to S&P 500 ratio. When it goes up, gold is outperforming. So two signals here. One is just this an ominous signal about the state of the economy. And it's a great buy signal to own gold in. So absolutely, I think it's very important that gold be in the portfolios, and it's a great diversifier. It has, virtually no real correlation to stocks. It depends on what people are buying or the reason people are buying gold at any given time determines its correlation to the stock market. Okay, so that new mix, if your portfolio is large enough to hold it all, this is what you want to see in an uncertain market environment. You can see much less red than our current allocation has. And you even have some green in here, and that's that short junk bond position. So folks, this is a portfolio that really provides legitimate diversification in an uncertain environment. You've got lots of things that are uncorrelated and some that are actually negatively correlated. Okay, so let's stress test it, but I want to do it one component at a time. So what I'm going to start with here is just the US equity allocation of our new core. So I'm going to separate that out, and I want to compare that to our current allocation to the S&P 500 and to the NASDAQ Composite Index. Okay, so I'd say stress test, but let's look at the last two bull markets, the previous one and the one we're currently in. Our current allocation is in the blue. That's where we are now. The green would be our new allocation. The orange would be the S&P 500, and the purplish would be the NASDAQ Composite Index. A lot of tech in there. So between the tech bubble bottom and the top of that subprime, bull market, if you will, our new allocation would have taken, looks like, third place. Our current allocation would have come in first, NASDAQ, and so forth. So we would have been up 144%. During the current bull market, our new allocation actually would perform better, ironically. Our existing allocation would be up 367%, about what the S&P is up. And then the NASDAQ, of course, is doing very, very well. Now, keep in mind with regard to the current allocation, in 2017, we were 17% tech. Right now, our target is 10. So our actual performance was better than what you see here. This just reflects where it is right now if you test it backwards. Okay, the last four big down markets, two nearly bear markets here and here. They were on a closing basis just under 20%, and then the two real bear markets. So the new U.S. equity allocation by itself, if this were a portfolio all by itself, would have been down 18% in 98 when the market came down almost 20. Current allocation, S&P, NASDAQ. tech bubble burst, the new allocation would have captured, a lot less, about, half of what the S&P and what the NASDAQ did, or a third of what the NASDAQ did. And then the Great Recession, where everything just got taken out to the woodshed, nothing did well. Everything was down 50+%. And then the 20% correction, 19.9% correction, fourth quarter of last year, current allocation, the blue, the new allocation just to US stocks, S&P and so forth. So you can see it's more defensive for sure. You can see that reflected here, here, and here. Again, 2008, nothing worked. Okay, so developed market foreign. So just the foreign stuff in developed markets. The prior bull market that outperformed, current bull market largely underperformed. And a lot of people are calling for a stretch of outperformance. Certainly valuations are more compelling in the foreign space. In the last 4 down markets, foreign underperformed, notably our other US allocations here. NASDAQ did the worst. Tech bubble, of course, NASDAQ did the worst, but foreign got hammered. Foreign got hammered here, but again, all of it was horrible. Foreign actually did a little better during the sell-off fourth quarter of last year. Foreign emerging markets, of course, your China's, Russia's, etc. Huge gains, the previous bull market, huge gains. And again, remember, China was building ghost cities and spending money like crazy, and it was equating to really rising Asian stocks. Not so much during the last stretch. Okay, so again, you can see why we want to own some of these areas just in case they resort back to that fiscal stimulus, which looks like they're going to. In the down markets, emerging markets, they are riskier. Bigger hits in these 3, although ironically, they actually went up a tiny bit during the fourth quarter of last year. Okay, so the currencies by themselves, just pull out the currencies, it's quite a different look. During the previous bull market, our currency exposure would have risen by 100% and just barely budged during this whole current bull market that we're in right now. During the last 4 big sell-offs, slight decline here, a lot less than the overall markets. But you can see it actually rose during the tech bubble burst a little bit, rose during the real estate bubble bursting, and was up a little bit here. So as you can see, that's where you get that negative correlation, at least in the currency markets, and that can be important, as you might guess, during uncertain times. Okay, so the complete allocation. So bring the core, all those components together. The current allocation, the S&P 500 and the NASDAQ composite. So the previous bull market, our current allocation actually would have performed the other comparisons, current allocation, S&P and the NASDAQ. Currently, however, it's been just a raging bull market and kind of reminds me of the 90s where tech has just gone up and up and up. So our new core allocation would have notably underperformed. What about in down markets? The Russia defaults, the tech bubble, real estate bubble, and last quarter, as you can see, that diversification can make a notable difference. Having said that, folks, we do not want to be in a position with conditions the way they are to suffer this kind of decline under any circumstances. So how do we mitigate that? Okay, first of all, we're going to look at the core portfolio with a 10% correction with and without a put option. So the new strategy, folks, is not to do the collar like we have on currently. The collar actually pays for itself. We sell a call. We actually sold a call spread so that we can recapture some upside if the market continued to move higher to pay for the protection down below. Initially, we don't want to do any of the upside selling of calls to pay for the protection. We don't want to put ourselves in a position to cap the gains if indeed the gains continue. But we do want to put ourselves in a position to, 1, capture them in an intelligent manner that's allocated consistent with uncertain times. But we also want to protect against some of that downside risk. So we're going to buy a put 10% below where the market is when we put it on, which is going to be very soon. We're not waiting for the old ones to expire. And then as we get into next year, we're going to look at it asset class by asset class. For example, if technology continues to look toppy like it is, we're going to go in periodically and sell covered calls on individual positions that we already own. And what that essentially means is that we take a security, let's say it's trading at $100 a share, and you don't see it going up 3%, which would be a huge move in a month. So you sell a call at $103 and you collect a premium. If the security stays at 103 plus the premium or below, the option expires a month later. It's a 1 month option, and you just keep the money. And that adds to the income to the portfolio and pays for the protection. Worst case scenario would be that the security goes screaming higher. We end up getting it called away, in my example, at $103 a share, let's say. And we make that 3% in a month, and then we turn right around and we buy the same one, or we buy a reasonable facsimile, whatever makes sense given where we are at that stage. It's a great way to generate income into a portfolio. Plus, it pays for the protection over time, just without the capping of it like we are doing currently. So what we did here is we took a $1.4 million account and we just applied the new allocation to it. So this is a 10% dip between now and April 15th, when the first put expires that we're going to put on. A 10% decline isn't 140,000 because of the diversification. It's about half of that. It's 70,000. With the put, a 10% decline is 75,000. Why is it 75,000? That's the cost of the put, and the put has a 10% strike. So we don't make any money if the market goes down 10% on the put. We just essentially pay for it. And this is without selling any covered calls to offset the cost. So what happens if we get a 20% decline, which on a closing basis is officially a bear market? Well, then the portfolio is down 140,000. But with the put, it's down 81,000. So with the put, we substantially reduce our loss in a 20% decline scenario. What about a 30% decline scenario? Your average bear market, and we are going to have a bear market sooner or later. I think right now, given the conditions that I shared with you yesterday, I think it'll be worse than your average bear market. But if it's average and it's a 30% decline, this portfolio drops by 212,000 without any put protection, drops by 79,000 with the put protection. And this is at expiration. Of course, if the market falls out a bit sooner, the put is really going to spike in price and it'll probably offset most or all of the losses. A 50% bear market, which is just the last two, actually a little better than the last two, frankly. Portfolio goes down 354,000. By the way, on a $1.4 million fully exposed portfolio, that's a success, because 50% of that would be 700,000, which would be twice that. But again, this is not going to feel like a success. With the put option, 76,000, we save hundreds of thousands of dollars. So folks, again, in the environment, the narrative that I established for you yesterday, we absolutely unequivocally do not want to play in this market without two things: this kind of protection and the kind of allocation that I just illustrated for you. And that is what we're going to, literally as I speak, begin rotating to. So when you get those confirmations, you'll know what that's all about. Those of you who have taxable accounts with big embedded capital gains, will be careful with that. We'll reach out to you if we need to get if we need to get your buy-in on creating a net taxable event. Of course, the selling of the collars while the market's up is going to create a tax asset. It's going to create a tax loss that we'll be able to offset a good chunk, if not all, of those gains with. So, okay, I'll leave it there. Thank you, as always, for watching and listening, and looking forward to next year and making adjustments that are consistent with what the market has to offer. Thanks again. Bye-bye.